Hello everyone, welcome to EduTap and welcome to Finance 360-degree session. In today's session, we are going to discuss a new notification of the Reserve Bank of India, the new directions that the RBI has released for the non-fund based facilities, okay? And this is going to be a very important direction for your regulatory body examination perspective. The question can come from this direction in the phase 1 of the examination as well as in the phase 2 of the examination, and the paragraph based question can also come from this direction, okay, because this is like very fact based and there are a lot of facts that the RBI has provided and a lot of clarity that the RBI has provided for the non-fund based credit facilities, for the guarantees, for the co-acceptances, for the PC. So all of this we are going to discuss in today's session so that you have the clarity about these non-fund based facilities as well as the facts that the RBI has provided, okay. So let's get started with today's session, but before that, give me a thumbs up if I'm clearly audible and visible and everything is going fine. Give me a thumbs up if everything is fine. So this direction is the new direction of the Reserve Bank of India and a lot of facts are given here that we are going to discuss. It is a complicated direction, but I have tried to break it down. So let's see this direction, okay. So first of all, before starting with the session, do subscribe to the YouTube channel of EduTap so that you continue getting the relevant videos, and do join our Telegram channel where you will get the PDF of the session, and the link for the Telegram channel is provided in the description box below, okay. So now starting with the news article or starting with the direction. So the Reserve Bank of India has released the non-fund based credit facilities directions 2025, okay. So non-fund based facilities, first of all, the banks, the NBFCs or the All India Financial Institutions and such, they provide the credit, okay. Now the credit facilities can be divided into two parts, the fund based and the non-fund based. Non-fund based. Fund based means that loans are given. Directly the money is given. The fund is involved here. So fund based, I hope you all know, fund based credit facilities are the credit facilities where the money is given, where directly the loans are given or the money is given by the banks or by the financial institutions. Now non-fund based credit facilities, these includes the guarantees, the co-acceptances and such, okay. So these are the non-fund based credit facilities where the funds are not disbursed, but these are the non-fund based credit facilities as they are helping the institutions to work smoothly. Let's take an example that the National Highway Authority of India has done an auction to hire a contractor to build a new national highway, okay. So basically National Highway Authority of India has done an auction to hire the contractor to build this national highway. So this contractor XYZ has been chosen. Now the National Highway Authority of India is afraid that what if this contractor do not construct this national highway within the given time limit. Let's say the contract is that this national highway has to be created within 2 years and the funds will be allotted by the National Highway Authority of India. So within 2 years, the national highway has to be constructed and the quality should be good. Now, the National Highway Authority of India is afraid that what if the contractor do not fulfill this promise to complete this national highway within 2 years, and what if the contractor takes 5 years, 10 years and keep on asking for the money. So that will create losses for the authority. So the authority wants the contractor to give a guarantee, okay, to take a guarantee for the National Highway Authority of India. So the contractor is going to the bank that give me the guarantee so that I can provide this guarantee to the authority so that I can get the contract, okay. So basically National Highway Authority of India, when it is providing the contract to the contractor for the performance, so performance guarantee is required by the National Highway Authority of India. So the contractor takes the performance guarantee, okay, buys this guarantee from the bank, let's say, to provide this to the National Highway Authority of India. That means if the contractor is not able to fulfill its obligations, if the contractor is not able to fulfill its promise within the given time limit, then the losses that the National Highway Authority of India will make, so all these losses will be covered by the bank as the bank is providing the performance guarantee on behalf of the contractor. So this is the kind of guarantee. So you can understand that the guarantees, they are the non-fund based credit facility. They are the non-fund based credit facility as the bank has not given the money directly. The bank is just promising and is providing the performance guarantee on behalf of the contractor, that if the contractor defaults, if the contractor is not able to perform, then the bank will have to give or cover the losses for the National Highway Authority of India. So these are the non-fund based credit facilities where the money is not disbursed directly, but the bank is taking the exposure or bank is taking the responsibility. Okay, so these are the non-fund based credit facilities, or these are the non-fund based facilities like guarantees, co-acceptances, etc. In the co-acceptance, we will discuss more about it. Basically, in the co-acceptance, what happens, that let's say the buyer is purchasing something and the seller is selling. So the bank is providing the co-acceptance of the bill that with the buyer, so that the seller is sure that if the seller is providing the material and the buyer is saying that okay, I will pay after 2 months, and the bank is giving the co-acceptance of the bill, that means the payment will be done. If the buyer is doing the payment directly to the seller, that is fine. If the buyer is not able to pay, then the bank will be responsible to pay to the seller. So this is the co-acceptance of the bill of exchange. Okay, so bill of exchange, the buyer is saying I will pay after 2 months. So the bank is having the co-acceptance that okay, after 2 months the buyer will be paying, and if the buyer is unable to pay or if the buyer defaults, then the bank will be responsible. The bank has co-accepted the bill, so the bank will be responsible to pay to the seller. So this lets the flow of transactions or the trade to happen smoothly, and the banks, they receive some fees for taking the risk or for taking a part of the risk. This is the idea. So non-fund based facilities like guarantees, co-acceptances, etc. facilitate the effective credit intermediation and smooth business transactions to happen between the different entities. Okay, so in order to harmonize and consolidate directions, now there were different directions for the guarantees, co-acceptances, for the partial credit enhancement. So there were different directions, there were different regulations for the non-fund based facilities. So now it has been said by the Reserve Bank of India that to harmonize and consolidate the guidelines covering these facilities across the entities regulated by the Reserve Bank of India, the RBI is broadening, and RBI is providing the directions, and to broaden the funding sources for infrastructure financing, the Reserve Bank had issued draft guideline on the non-fund based facilities for public comments. This was released in April 2025, and after the comments have been received from the public, after the feedback has been received from the public, the RBI has seen that feedback, and now the RBI has released the final directions. So basically, the RBI said that the non-fund based facilities, for them, there were different guidelines. So to consolidate the guidelines and to harmonize the guidelines for the regulated entities for these non-fund based facilities, as well as to provide and to broaden the funding sources for the infrastructure financing, the Reserve Bank of India released the draft guidelines in April, and after getting the feedback, after getting the comments, now the RBI has released the final guidelines in August. Okay, so in an exercise of the powers conferred to the Reserve Bank of India through the Banking Regulation Act of 1949, Reserve Bank of India Act of 1934, National Housing Bank Act of 1987, the Reserve Bank of India has released the Reserve Bank of India Non-Fund Based Directions 2025. These are the final directions released in August 2025. Now the definitions have been given in the directions. So let's understand the definitions. First of all, the beneficiary means the party in whose favor the NFB facility is issued by the regulated entity. So beneficiary means the party in whose favor the NFB facility is issued. So that means the beneficiary will be the one that will get the money finally. Okay, so here you can see that the beneficiary is National Highway Authority of India here, because the National Highway Authority of India has got the assurance that in case the contractor is not able to perform within the given time limit, the losses will be covered by the bank. Okay, in the case of the bill of exchange, the co-acceptance by the bank has co-accepted the bill, so seller has got the security that the seller will get the money. The seller do not have to worry about the money. Okay, so beneficiary is the one, the beneficiary means the party in whose favor the facility is issued by the regulated entities, so that the beneficiary can get the funds at last. Okay, now co-acceptance of bills. Co-acceptance of bills, as we have discussed, this means to make payment to the drawer of the bill to the seller or exporter on due date if the buyer or importer fails to make the payment on that day. So basically, The co-acceptance of bill means that if the bank is co-accepting the bill and if the buyer defaults in the payment, then the bank will make the payment to the seller. So seller is secure that the seller will get the payment or the exporter will get the payment. Okay, so co-acceptance of bill means that the bank is undertaking the responsibility to make the payment to the seller or to the exporter if the buyer defaults, if the buyer do not make the payment. Okay, guarantee means a contract to perform the promise or discharge the liability of a third person in the contingent case of his non-performance. Third person is the contractor here, that if the contractor is not able to perform or defaults, so the guarantee is given by the bank that the bank will take the liability and will take over the losses that is faced by the authority. Okay, so guarantee means a contract to perform the promise or discharge the liability, to cover up the liability, to cover up the losses in the contingent case of the non-performance or default. Okay, this is the idea. Guarantor refers to the party which issues the guarantee. So guarantor is the party which is issuing the guarantee. So the bank is the guarantor, or in this case the guarantor can be mainly the bank, the scheduled commercial bank, the urban cooperative banks and such. So guarantor refers to the party which issues the guarantee. Usually it is a bank. Obliger refers to a party against whose obligations, financial or otherwise, a NFB facility has been issued. Okay, so basically the obliger is the one that has the obligation to give the money or to perform. So contractor is the obliger here. The contractor is the obliger that should oblige the contract and that should perform in a good manner. And here the obliger is the buyer that should pay the bill. Okay, so obliger is the one that refers to a party against whose obligations, financial or otherwise, a NFB facility has been issued. In the case of guarantees, the obliger may also be termed as principal debtor. Okay, so in the case of guarantee that is given, so the obliger can also be the principal debtor that has taken the debt. So against the debtor, the guarantee can be given. Okay, as defined under the Indian Contract Act 1872. Secured portion of an NFB facility. So secured portion of the NFB facility means that, let's say, against this performance guarantee that the bank is giving, the contractor is also giving the bank some collateral. Let's say some property is given as collateral to the bank, so that if the contractor actually defaults and is not able to perform, so the bank can use this collateral to pay for the losses of the authority. Okay, or let's say in this case, the buyer has given some collateral to the bank. Let's say some property or some land is given as collateral to the bank. So if the buyer is not able to repay the bill to the seller and the bank has to pay the bill to the seller, so the bank can use this collateral and sell this collateral to pay the bill to the seller. Okay, so this is the secured facility. So secured portion of an NFB facility is the portion of the facility that is covered by the realizable value of a tangible security or collateral estimated on a realistic basis. So basically secured portion, if the NFB facility, if the guarantee or the co-acceptance is worth, let's say, 10 crore and the collateral that is given by the buyer or the contractor is worth 8 crore. So that means more than half, nearly 80% of the guarantee is covered, is secured through the collateral. That is the idea. Any confusion in the definitions? The guarantee, the co-acceptance of bills, is it clear? Any confusion, anyone? Moving forward with the applicability now. Moving forward with the applicability. So basically these directions are applicable on commercial banks, including regional rural banks, local area banks, the primary urban cooperative banks, the state cooperative banks, the central cooperative banks, all India financial institutions. So for the guarantees, for the co-acceptances, the directions are applicable on these institutions. For the partial credit enhancement that we are going to discuss in the later on slides, for the partial credit enhancement, there is a separate applicability criteria that is provided, and the NBFCs, including housing finance companies, in middle layer and upper layer. So the NBFCs are divided into different layers. Okay, the base layer, middle layer, upper layer and top layer. So basically NBFCs, including housing finance companies in middle layer and above, only for the issuance of partial credit enhancement as permitted under chapter 4 of these directions. So basically these directions are applicable on the banks, on the commercial banks as well as the primary urban cooperative banks and such all India financial institutions. For the partial credit enhancement, these directions are also applicable on the NBFCs, including the housing finance companies in the middle layer and above, only for the issuance of partial credit facility. Okay, this is the idea. Now, these directions shall come into force from April 1, 2026 or from any earlier date that is decided by the internal policy of the regulated entity. But from this date onwards, the directions has to be followed. The regulated entities can follow it from a prior date also, but not a later date. Okay, this is the idea. Now, conditions applicable to the guarantees. So, there are certain general conditions also, but those general conditions we will discuss at the end. So, first of all, conditions applicable only for the guarantees. So, in general, a guarantee or a counter guarantee means, let's say, the regulated entity has provided the non-fund based facility. It can be any non-fund based facility that is provided by the regulated entity. Now, the regulated entity is taking a guarantee from another regulated entity. So, this is a counter guarantee, that against the guarantee or against the non-fund based facility, another guarantee is provided. So, that is counter guarantee. Okay. So, in general, a guarantee or a counter guarantee issued by a regulated entity, that is the guarantor, shall be irrevocable, that cannot be revoked by the regulated entity. Unconditional, that means there should be no clause where it is said that the guarantor do not have to pay. So, the unconditional, the guarantee is unconditional. In any case, the guarantor will have to pay in case of default by the obliger. Okay. Incontrovertible, that means indisputable, the payment has to be made, as well as shall contain a clear mechanism for honoring the same without reluctance as and when involved. So, basically, if a guarantee is given or if a counter guarantee is given, then the regulated entity has to pay the money in case of default happens, in case of non-performance. Okay. So, basically, the guarantee is unconditional, it is irrevocable, it is indisputable, as well as a clear mechanism should be there for honoring the guarantee without reluctance. A regulated entity shall put in place suitable internal, aggregate or individual ceilings on the guarantee, the total amount of the guarantee or total percentage of the guarantee, as well as on the unsecured guarantees. So, some guarantees are secured, some guarantees are unsecured. So, basically, it is said that the regulated entities, they should put a barrier or they should put the ceilings on the guarantee, on the total guarantee, as well as on the unsecured guarantees. Okay, so there should be individual ceilings and aggregate ceilings. So there should be aggregate total ceilings on the total guarantees and total ceiling on the unsecured guarantees, as well as on the single guarantee that is provided to the regulated entity, that there should also be limits. Okay, provided that the total volume of guaranteed obligations of urban cooperative banks, RRBs, local area banks, state cooperative banks, central cooperative banks outstanding at any time. So, guaranteed obligations that is outstanding at any time for these entities shall not exceed 5% of their total asset as per the previous financial year balance sheet. Further, unsecured guarantees of these regulated entities shall not exceed or shall be restricted to 1.25% of the total assets. So, this is the idea that basically the regulated entities have to decide the total limit on their guarantees, total limit on their unsecured guarantees, as well as individual limits for the individual contract. The limits have to be decided for the guarantees and unsecured guarantees. But for the urban cooperative banks, for the RRBs, for the LABs, there is some limits that have been notified. That is, for the guaranteed obligations shall not exceed 5% of total assets, and for unsecured guarantees it should be restricted to 1.25% of total asset. This is the idea. Now, the provisions of the internal policy relating to guarantees shall include and address aspect related to invocation and settlement mechanism, how the guarantee will be settled, in what cases the guarantee will be invoked, claim period, tenure, fee, commission, applicable charges that will be taken by the regulated entity, timelines for release of security, renewal, fraud prevention measures, etc. So, basically, for the guarantees, the internal policy should be very detailed in all the terms and conditions. Now, usage of electronic guarantee. So, basically, the guarantee can be provided through the electronic means, through the e-means also. This is e-guarantee, where the physical forms or the physical documents are not taken, everything happens through the electronic processes. So where a regulated entity issues an electronic guarantee or e-guarantee, it shall frame a standard operating procedure so that there is minimization of manual intervention and the process happens smoothly through the electronic means, meeting system integration requirements, ensuring technological compatibility between the regulated entity interface and the electronic guarantee platform, so that the interface of the regulated entity is working smoothly with the electronic guarantee platform and all the documents are taken through the electronic means and checked and such. Okay. Now, guarantee favoring another regulated entity. As I have told you that there can be a counter guarantee. Counter guarantee basically means that the regulated entity has given a non-fund based facility a guarantee or letter of credit or any other non-fund based facility. So another regulated entity is providing guarantee for this regulated entity that has provided the non-fund based facility to some XYZ entity or person. So this is a counter guarantee, that is guarantee on guarantee. Okay, that is the idea. Any confusion till now? Yukta, you will understand the NBFC criteria better when we discuss the PCE, that is partial credit enhancement. Okay, then we will discuss the NBFC criteria in more detail. So basically this NBFC criteria we will discuss more detail when we discuss about the partial credit enhancement. Okay, for there are different conditions there. Okay, so guarantee favoring another regulated entity. So basically it is said that a regulated entity shall in general not provide a guarantee favoring another regulated entity to enable it to provide any fund-based credit facility to an obliger. So basically it is said that a regulated entity that is providing, let's say, loans, that is a fund-based credit facility because directly fund is released. So if a regulated entity is providing loans to XYZ, that is the obliger who has the obligation to return the loan. So if a regulated entity is providing the fund-based credit facility to the obliger, so no other regulated entity should provide any guarantee to this regulated entity. So no guarantee should be provided in this case, provided that this clause will not be applicable in case of the credit facility that is provided for the trade related transactions, because we have to boost the exports, we have to boost the export from our country. So for the trade related transactions, the guarantee can be provided by the regulated entity to another regulated entity for the loans that is provided for the trade related transactions. But for any other type of loan that is taken, for any other home loan or car loan or like for these kind of transactions, the regulated entity should not provide the fund based credit facility. Okay, so this is the idea, that basically regulated entity shall in general not provide a guarantee favoring another regulated entity. So guarantee should not be provided for another regulated entity that enable it to provide any fund based credit facility, provided that this clause shall not be applicable in case of the credit facilities extended against guarantees pertaining to trade related transactions. Okay, however, a regulated entity, but as we have said before, a regulated entity can provide a guarantee to another regulated entity that is providing the non-fund based facility to the obliger to the XYZ. So basically for the fund based credit facility, there should be no guarantee that is provided by the other regulated entity, but for the non-fund based facility, there can be a guarantee that can be provided by another regulated entity. Is this clear first of all? So however, a regulated entity may provide a guarantee favoring another regulated entity for a non-fund based facility extended by the another regulated entity. Such guarantee issued by the regulated entity shall be treated as the exposure. So this guarantee is the exposure to the XYZ, because at last the XYZ is the obliger that should oblige with the regulations, that should like complete its liability. But if the XYZ is not completing its liability, so the final guarantor will have to complete the guarantee, okay, or will have to provide the funds. So the final guarantor is having the exposure to the XYZ, and XYZ is the one that have to oblige. Okay, now the claim or exposure on the regulated entity. Now the regulated entity that is providing the NFB facility can claim the money from the final guarantor. Okay, this is the idea. Okay, so basically let's summarize this. So regulated entity issues guarantee to another regulated entity for fund-based credit to customer. This is not allowed. So basically, if the regulated entity is providing the loans or fund-based credit facility to some obliger, so the regulated entity cannot take a guarantee from another regulated entity. The same is allowed for the trade related credit. So for the trade related credit or for trade related transactions, this kind of this kind of guarantee is allowed. This kind of guarantee is allowed. So basically, the regulated entity cannot provide guarantee to another regulated entity for the fund based credit facility, but this kind of guarantee is allowed for the trade related transactions. Okay. Next is that the regulated entity can issue the guarantee. The regulated entity can provide the guarantee to another regulated entity for the NFB facility. Okay. So regulated entity can provide the guarantee to another regulated entity for the non-fund based facility. This is allowed. Exposure is considered to be on the obliger, because at last the obliger is the one that has to oblige with the terms and conditions, and the obliger is the one that should be fulfilling its liability. If the obliger is not fulfilling its liability, so basically the regulated entity, the final regulated entity that is providing the guarantee, has the exposure to this obliger. Okay. Now the claim, the regulated entity that is providing the NFB facility can claim the money from the final regulated entity that is providing the guarantee. So exposure for a regulated entity giving the NFB facility. So the regulated entity that is giving the NFB facility can claim the money from the guarantor. Okay. So on the guaranteeing regulated entity, this is the whole idea. Any confusion here? Now any confusion in this one? So actually there are 4 criteria that you have to remember, 5 criteria that you have to remember that I have written here. So regulated entity should not provide any guarantee to another regulated entity to provide the loan, but this kind of clause is not applicable for the trade related transactions. Okay. The regulated entity can provide guarantee to another regulated entity that is providing the NFB facilities to the obliger. So this is allowed, and in this case the exposure is with the obliger. The regulated entity that is providing the final guarantee has the exposure to the obliger, and the regulated entity that is providing the NFB facility can take the money from the final regulated entity that is doing the guarantee. This is the idea. Now coming to the next one, that is conditions applicable to co-acceptance. Okay. So we have discussed the conditions applicable to guarantee. Now conditions applicable to co-acceptances. Co-acceptances, we have discussed that this is basically the bank that is taking the responsibility to pay to the seller if the buyer defaults. Okay. So that is co-acceptance of the bill. The bank is co-accepting the bill with the buyer. If the buyer is making a payment to the bank, or the buyer is giving a fee to the bank, so bank is agreeing to co-accept the bill so that the seller provides the material to the buyer. Okay. So basically seller is saying that I can provide you the material, but what is the guarantee that you will pay after 2 months? So buyer is saying that okay, I will take the guarantee, I will have the bank co-accept the bill so that if I am unable to pay, at least the bank will pay to you, so you will be safe. Okay. So this is the co-acceptance of bill. Now only genuine trade bills shall be co-accepted, and it shall be ensured that the goods covered by bills co-accepted are actually received in the stock accounts of the borrower or the buyer. So basically only genuine trade bills should be co-accepted. It's not like that there is no trade that is happening, but still the bill is made, still the bank is co-accepting. So that should not happen. If the bank is co-accepting the bill, there should be some transaction that should be happening between the seller and the buyer. There should be some goods that the buyer is purchasing. Okay. So it should be genuine. Proper records of the bills co-accepted for each customer shall be maintained so that commitments for each customer and the total commitments at the branch level can be readily ascertained, that for each customer how many of the bills have been co-accepted, and at the branch level how many bills have been co-accepted, and the internal audit can also happen. A regulated entity shall not co-accept bills drawn by another regulated entity. So that means co-acceptance cannot happen if the buyer is the regulated entity. So regulated entity shall not co-accept bills drawn by another regulated entity, or where the buyer or seller has received funding for the underlying trade transaction from any regulated entity. Because if you have taken loan from some other regulated entity for your trade transaction, take the co-acceptance bill from that regulated entity only. So basically where the buyer or seller has received funding for the underlying trade transaction from any regulated entity, then co-acceptance of the bill cannot happen because you have already taken the loan. So there is no requirement. If you have already taken the loan for your transaction, if you have already taken the loan for your transaction, so make the payment. Now, why do you require the co-acceptance of bill? Then there should be no requirement of co-acceptance of bill. So basically, where the buyer has already taken the loan for the transaction, then there is no co-acceptance of bill that is possible. Okay, this is the idea. Next is that requirements for other specific guarantees. So there are other kinds of guarantees for that, like the guarantee and related business involving overseas current or capital account transactions. Current account transactions means the trade in goods, the trade in services. Capital account transactions usually involve the investment that we are doing outside, or the foreigners, they are doing investment in our country. So the current account transaction, and for capital account transaction, the guarantee and the related business, that we have to understand. So basically, the regulated entities that is permitted as authorized dealer, that is permitted to like undertake the transaction in the foreign exchange. So regulated entities that is permitted as the authorized dealer may extend NFB facilities, may extend the non-fund based facilities as permitted under the existing regulations or directions issued under the Foreign Exchange Management Act of 1999 for bona fide current or capital account transaction, including guarantees in respect of debt or other liability incurred by the exporters of our country. So basically, when we are talking about the exporters of our country, the guarantee can be provided. Basically, this is the idea in regards or in by following the rules and regulations under the Foreign Exchange Management Act. So basically, the regulated entities of our country, that is working as the authorized dealers, they can provide the guarantee for the current account, for the capital account transactions on behalf of the exporters in regards to the FEMA regulations also. This is the idea. Okay. Next is, see, now why the exporters require the guarantee? Because let's say the exporters, they are exporting their product to other countries. So the exporters, they are taking the shipping facilities, okay, or they are taking some like warehousing facilities in between. Let's say in UAE, like the exporters are exporting the product to US. So the warehousing is happening in UAE. So for the warehousing facilities, for the shipping facilities, the exporter have to pay a lot. So for that, the exporter is not able to pay right now. The exporter is saying that when the product is transacted, or when the product is like finally like exported to the US and it finally goes to the US, then the payment will happen. So the shipping vessels and the warehousing will say that, okay, what is the guarantee that you will pay after the goods have reached to US? So exporter is taking the guarantee from the bank or from the regulated entities, that is the authorized dealers, that okay, the exporter will pay. If the exporter is not able to pay, the bank will pay. Okay, so this is the idea, that the exporters also require the guarantees for the payments of the shipping or for the payments of the warehouses and such, because the exporters do not pay directly. Now, authorized dealer banks are also permitted to issue guarantee to or on behalf of a foreign entity in which an Indian entity has acquired control, or the step down subsidiary in which the Indian entity has acquired control. So basically, the authorized dealer banks, they are allowed to provide the guarantee, to issue the guarantee to or on behalf of the foreign entity or the step down subsidiary in which the Indian entity has got the control, okay, which is backed by a counter guarantee or collateral by the Indian entity. So the Indian entity that has got the control of the foreign entity, that should provide the counter guarantee, or that should provide the collateral for the guarantee that the bank is giving. So the collateral has to be provided by the Indian entity for the guarantee that the Indian bank is providing or the authorized dealer bank is providing, provided that such guarantee shall only be issued for the ordinary course of business overseas, not for any other purpose. Okay, so provided that such guarantee shall not be issued by banks including overseas branches or subsidiaries of the Indian banks for the purpose of raising loans or advances of any kind by foreign entity except in connection with the ordinary course of business overseas. So basically, if we are talking about the authorized dealer banks, so authorized dealer banks, they can provide the guarantee to the foreign entity or to the step down subsidiary of the foreign entity if the Indian entity has got the control of this foreign entity, basically. So the guarantee can be provided by the authorized dealer bank, but the Indian entity that has got the control of the foreign entity should provide some collateral to the authorized dealer bank. As well as this guarantee that is being provided by the authorized dealer bank or the guarantee that is provided by the Indian bank or the overseas subsidiaries or the overseas branch of the Indian bank. So this guarantee can only be provided for the loans that is taken by the foreign entity for the overseas operations, for the regular operations of the business, not for any other thing. Okay, so this is the idea. Now, guarantees on behalf of stock or commodity brokers. Any confusion in this? Anyone? So basically, guarantees on behalf of stock or commodity brokers. So only the scheduled commercial banks may issue guarantees on behalf of stock or commodity brokers. So try to understand this with an example that, let's say, a stock broker wants to trade on the XYZ exchange. Okay, let's say Zerodha or any XYZ, any stock broker wants to trade on the NSE stock exchange, National Stock Exchange, or the Bombay Stock Exchange, or any other stock exchange. So if a stockbroker wants to trade on any exchange and is required to keep a margin of, let's say, 10 crores for the transactions that is happening through the stockbroker, so instead of blocking 10 crore rupees in cash, the stockbroker asks a scheduled commercial bank to issue a guarantee that the stockbroker will pay. If the stockbroker is not able to pay, the bank will be liable to pay. So the stockbroker is saying that we do have the money, but we can invest that money and we can earn more from that money. So why should we keep that money lying idle? So rather than giving the money, so stockbroker basically is saying that rather than giving 10 crore rupees in the margin requirement, the stockbroker would rather invest this money and earn more. So stockbroker is saying to the bank that, okay, we do have the money, but can you give the guarantee to the stock exchange that if we are not able to pay the margin, so the bank will pay the margin. So bank is giving the guarantee and the bank will get a good fees for providing this guarantee. Okay, so basically the stockbrokers, rather than making their funds lying idle or rather than blocking their funds, they take the guarantee from the bank and bank provide the guarantee for a good fees. Okay, so exchanges allow bank guarantees. So the stock exchanges, NSE, BSE and such, they can allow the bank guarantees from the scheduled commercial bank. They also have certain rules and regulations that have to be followed. Okay, so basically the scheduled commercial bank can provide the guarantees on behalf of the stock or commodity brokers in favor of the exchanges, stock exchanges, commodity exchanges, in lieu of security deposit to the extent that is acceptable by the stock exchanges. So stock exchanges do not accept like hundreds of crores of guarantees. Let's say the exchanges also have certain limits, that what limit of guarantee they can accept. So this is the idea. Next is coming to the partial credit enhancement. So now your confusion will be cleared. So basically the NBFCs, they are not allowed to provide the guarantees, they are not allowed to provide the co-acceptance of the bills. Okay, so basically here it was written that the NBFCs, they are only allowed for the issuance of partial credit enhancement. Okay, so basically the NBFCs, including housing finance companies in middle layer and above, they only are allowed to issue the partial credit enhancement. That means they cannot provide the guarantees, they cannot provide the co-acceptance of bills. So this is the idea. Okay, now let's understand about the partial credit enhancement. What does this mean and what is the applicability criteria? So partial credit enhancement, the scheduled commercial bank excluding the RRBs, all India financial institutions, NBFCs including housing finance companies in middle layer and above, together these are the regulated entities that may provide partial credit enhancement. Okay, to bonds. Now partial credit enhancement can be provided for the bonds that is issued by the corporate, corporates or special purpose vehicles, that is some subsidiary that is opened by the corporates for a particular project. Okay, so basically partial credit enhancement can be provided for the bonds issued by the corporates or special purpose vehicles for funding all type of projects, and for the bonds that is issued by the non-deposit taking NBFCs, with asset size of 1000 crores and above, registered with the Reserve Bank of India, including the housing finance companies. So partial credit enhancement can be provided by scheduled commercial bank excluding RRBs, all India financial institutions, NBFCs and including the housing finance companies in the middle layer and above. These can provide the partial credit enhancement for the bonds issued by the corporates or special purpose vehicle for any project or the bonds that is issued by the non-deposit taking NBFCs that have the asset size of 1000 crores and above registered with the NBFC, or the PC can also be provided for the bonds issued by the municipal corporation, okay, as per the guidelines being followed. Okay, the objective behind allowing the regulated entity to extend the PC. So what is PC, why this can be provided, or why this is required? Okay, so basically let's understand the objective of the PC. Any confusion till now, anyone? So what is the requirement of the PC, or what PC is? So partial credit enhancement, this shall be subordinated facility. This is the facility that is provided by the scheduled commercial banks, all India financial institutions, or NBFC, including housing finance companies that is in middle layer or above. So these entities can provide the partial credit enhancement. That is a subordinated facility provided in the form of an irrevocable contingent line of credit, which will be drawn in case of shortfall in cash flows or servicing the bonds, and thereby improve the credit rating. So basically, if you want to understand the partial credit enhancement, this is basically the banks, the scheduled commercial bank or the all India financial institution, they are providing the PC for the bond, so that this PC is actually, it is not a guarantee that okay, the payment will be given to for the bonds. Okay, so partial credit enhancement is actually a credit facility. Partial credit enhancement, this is actually a credit facility or subordinated facility, that is a contingent. This is a contingent credit facility. Contingent credit facility that can be provided in the future when the entity that has sold the bonds, let's say the entity XYZ has sold the bonds to the investors. Now the entity is giving the interest payments. The bonds are what? Through the bonds, the entity has raised the money, let's say 10 crores has been received by the entity from the investors, and entity has said that on the half yearly basis, the interest of 6% will be paid on every 6 months, let's say. Now the XYZ entity is paying and this bond is taken for 5 years. This has the maturity of 5 years. The bond has the maturity of 5 years. Now the 6% of interest is paid for 2 years, but now the XYZ entity is facing problem and the XYZ entity is not able to pay the interest to the investors. Now the investors, they are afraid that what if the entity is not able to return our money, if they are not able to pay the interest. But this is only a short-term problem that the entity is facing, but the investors will lose trust on this bond. So the entity do not want this. That's why entity is going to the bank, or before issuing the bond, the entity goes to the bank to take the partial credit enhancement, where the entity says that if we are not able to pay at any time, the bank will be liable to pay. Okay, the investors are having trust on this bond now. That okay, if the entity is not able to pay the interest payments, if the entity is not able to pay the maturity amount also, the bank will be liable to pay. Now, why the bank is paying? The bank is getting the fees first of all, and this is a partial credit enhancement. That means it is a future credit facility. It is not like that the bank will pay and then the entity will not have to pay. No, entity will, this is a kind of loan that the entity is taking. So basically the entity that is issuing the bond, if it is not able to pay to the investors any amount, let's say it is not able to pay interest on some day, on some month, so the entity can take the borrowing immediately, or the money can be borrowed from the bank that has provided the partial credit enhancement. So partial credit enhancement is not a guarantee that okay, if the entity is not able to pay, the bank will pay. No, the bank is saying that we will provide a credit facility so that the payments are made to the investors. Okay, this is the idea. So PC is basically subordinated facility provided in the form of irrevocable contingent line of credit. That means if the entity is not able to pay the interest payments, is not able to pay any bond payments, then the bank has to provide the credit to the entity so that the entity can provide the money to the investors. Okay, so this is the idea. So this is irrevocable contingent line of credit, so that the bond holders or the investors, they get the money on the timely basis, when there is any problem that is coming in the entity. Any confusion here? So basically, if the bond issuer is not able to pay at any time, so the bank that has provided the partial credit enhancement for this bond, so the bank will have to provide the loan or the credit to the bond issuer, so that the bond issuer can make the payment to the bond holders or the investors. Okay, now the bond issuer is liable to repay the money to the banks. This is the idea, and this is a short-term fund that is given to the bond issuers. Now this is the idea of the PCE. Now PCE exposure limit by a single regulated entity shall be 50% of the bond issue size. That means if the bond size is 10 crores, so the PCE can be maximum up to 5 crores. This credit limit can be maximum up to 5 crores. The aggregate exposure limit by all the regulated entities combined for the PCE can be 50% of the total bond issue size. That means for the single regulated entity also 50% of the bond size, as well as for all the regulated entities combined, for a single bond the limit is 50% only. The PC facility shall be provided at the time of the bond issue, when the bond is just getting issued, and shall be irrevocable. That means whenever the bond issuer is facing any problem to pay to the bond holders, the bank should be liable to pay or should be liable to give the credit to the bond issuer. Okay, and this also build the trust of the investors on the bond issuer, that whatever happens we will get our money. The bond holders or the investors, they know that whatever happens we will get our money, because the bank can provide the immediate credit to the bond issuer for paying to the bond holders or the investors. This is the idea. Okay, so PC cannot be provided by way of guarantee. It is not a guarantee, because in the guarantee what happens, in the case of guarantee, if the person or the entity is not able to fulfill its obligation, so the bank has to complete the obligation. The bank is liable to complete the obligation, and the bank is the one that is liable at the end. But in the case of PC, this is just a kind of credit, that is this is just a kind of contingent, that is future credit that is signed. Okay, that if the bond issuer is unable to pay to the bond holders or the investors, then the bank will just provide the credit that is under the partial credit enhancement. The bank or the NBFC will provide the credit so that the bond issuer can make the payments, but the bond issuer will be liable to repay the money to the bank or the NBFC. Okay, so PC cannot be provided in the form of guarantee. It is a contingent line of credit. It is a future line of credit kind of thing. Okay, regulated entity may offer PC only in respect of bonds whose pre-enhanced rating. Pre-enhanced rating means, basically it means, see, when the bond is being issued by the issuer, it gets some rating. Let's say it has got the rating AA. Now, once the bond is the bond has got the PC, that is partial credit enhancement from a bank or the NBFC. So this is an additional layer of security for the bond holders or the investors. If the bond issuer is not able to pay, at least the money will flow from the banks. Okay, the credit will flow from the banks to the issuer, so that the money can be paid to the investors. So this is the additional form of security. So once the additional form of security has been provided for the bond, then the bond rating has increased to, let's say, A plus or A plus plus, let's say. So basically, regulated entity can offer the partial credit enhancement only for the bonds whose pre-enhanced rating, before getting the PC, the rating should be above BBB minus. Okay, not lower than BBB minus, as issued by accredited external credit enhancement institutions. To be eligible for PC, corporate bonds shall be rated by a minimum of 2 ECAI at all the times. Okay, next is the rating reports. Both initial and subsequent shall be disclosed. Both standalone credit rating, that is when the bond issuer did not get the PC, then what was the rating, as well as after getting the PC, what was the enhanced rating. Okay, so after getting the PC, there is an enhanced or higher rating that will be provided, because of course security has been provided. Okay, so basically standalone rating as well as the enhanced rating, these both ratings have to be shared. The PC facilities to the extent drawn. So basically, let's say that the PC is, that the bond is issued, the bond issuer is issuing the bond worth 10 crores. The PC is provided for, let's say, 3 crores. the PC, the partial credit enhancement is provided by the NBFC worth 3 crores. Out of this, let's say bank is facing the problem to pay the interest, and the bond issuer is facing the problem to pay the interest at one time. So the bond issuer has taken, let's say, the credit of 50 lakhs to pay to the bond holders the interest. Okay, so bond issuer has already taken the credit of 50 lakhs under the partial credit enhancement. That means 50 lakhs have been drawn. 50 lakhs have been drawn from the bank. Now how much is left? The undrawn facility is now 2.5 crores. 2.5 crores. So basically the drawn facility, the PC facilities to the extent drawn, that is the money that has already been taken out from the credit facility, from the line of credit, shall be treated as on balance sheet advance. This will be the advance or the credit that is given, that should be treated as on balance sheet credit, and on this credit that is given by the bank or the NBFC, the capital adequacy has to be maintained, provisions has to be maintained and such. Okay, this is the idea. And the undrawn facility, so 2.5 crore, that is undrawn facility, that is not drawn, that the money is not taken till now, so that will be off balance sheet exposure. Okay, the capital required to be maintained till now, any confusion? So basically PC, now the capital required to be maintained by the regulated entity providing the PC for a given bond issue shall be based on the PC amount. So basically it is saying that, let's say the bond size is 100 crores. The bond size is 100 crores. This much is the bond value. Okay. Now the PC is provided 20%, that is 20 crores of the partial credit enhancement is provided. Now this partial credit enhancement, it has certain risk, that what if the bond issuer takes the loan and not returns the loan, because PC is a contingent line of credit, it is a credit, but what if the bond issuer do not return the loan to the bank itself? So there is some risk that is involved. Okay, so if the PC is worth 20 crores, okay, multiplied by the, or 20% is the PC, multiplied by the 100% is the risk weight. Let's say 100% is the risk weight that is given to this credit, that is given to the bond issuer. Okay, now how much of the capital adequacy that has to be maintained? So let's say 9% of capital adequacy has to be maintained. So this is the idea. Okay, that there is capital adequacy that has to be maintained, or adequate capital has to be maintained for the loans or for the contingent credit line of credit for the PC. For the PC, there is adequate capital that has to be maintained. So capital is required to be maintained by the regulated entity that is providing the partial credit enhancement for a given bond issue. This shall be based on the PC amount, the amount of the PC. Let's say PC amount is 20 crore. The risk weight is, let's say 100%, it can be 50% if the credit rating, if the bond rating is very high, that means there is less risk. Okay, let's say bond rating is AA plus or higher than that, so risk weight can be low. But if the bond rating is, let's say BBB minus, that is near to the lower limit, so then the risk weight is, let's say 100%, and the adequate capital that has to be maintained is 9%, let's say. Okay, so this is the idea, that adequate capital has to be maintained. So here, let's say the PC amount, so total bond size is 100 rupees. The PC amount is, let's say 20. So 20 rupees is the PC, that is partial credit enhancement is 20 rupees. That is the line of credit, the contingent line of credit. 100% is the risk weight multiplied by the capital that is required. Okay, so 1.8 is the capital requirement that the bank or the NBFC will have to follow. Next is that it is possible that the credit rating can change after the bond has been issued. So credit rating can increase or decrease, or the bond rating can increase or the bond rating can decrease. If the bond rating is increasing, that means the bond is stronger now, in the sense that there is more trust on the bond and the bond issuer, that is the corporate or the company. Okay, so if the bond rating is increasing, the capital requirement can be decreased, because the bond rating has been increased. If the bond rating has been increased, the risk weight has decreased from 100% to 50% or 20%, let's say. So if the risk weight is decreasing, the capital requirement will also decrease. But the capital requirement, it is said that the capital requirement, even if it is decreasing, it should be subject to the minimum of the capital requirement that was initiated, or the initial phase when the PC was given. When at that time the capital requirement that was maintained, that has to be continued. Okay, so basically the partial credit enhancement, at the time the partial credit enhancement was given by the bank or by the NBFC, at that time whatever capital requirement was maintained as per the ratings of that time, so that capital requirement has to be maintained even if the credit rating or the bond rating is increasing. The minimum capital requirement should be the capital requirement. The minimum capital requirement has to be maintained at the time of issuance of the PC enhanced bonds. So this is the idea कि जब जो बॉन्ड है इशू हुआ था उस समय जो पीसी जब बॉन्ड इशू हुआ था उस समय जो पीसी दैट इज पार्शियल क्रेडिट एनहांसमेंट था, उस समय जो बॉन्ड रेटिंग थी उसके हिसाब से जो भी क्रेडिट रिक्वायरमेंट मेंटेन किया गया है उसको कंटिन्यू करना है. ठीक है, चाहे बॉन्ड रेटिंग इंक्रीज क्यों ना हो जाए, उस लेवल से कम नहीं हो सकती. ठीक है, so subject to a floor. This is the idea. Now if the bond rating is decreased, then more credit requirement will have to be maintained. This is the idea. So if the bond rating has decreased, there will be more credit requirement as there is more risk. If the bond rating is decreasing, there is more risk, so more credit requirement. But in the case bond rating is increasing, there is lesser credit requirement, but the credit requirement has a floor. That is, the credit requirement should be the minimum credit requirement at the time of issuance of the PC enhanced bonds. Okay. Next is, as long as the bond outstanding amount exceeds the PC. So basically, let's say the PC is 100 crores. Bond was initially 500 crores. So bond was worth 500 crores. The PC is 100 crores. So capital that was required to be held, let's say, was X amount. Now the bond has been amortized. That means most of the bond repayment has happened. Now the bond value is only 90 crores. Only 90 crores have to be repaid. So now bond value that has to be repaid is 90 crores, while the PC value is 100 crores. That means partial credit enhancement value is 100 crores. That means now PC is more than the bond value. So capital can be reduced. The capital can be reduced now, even below the floor value. Okay, so this is the idea. Next, so as long as bond outstanding amount exceed, if the bond value is exceeding the PC value, then the adequate capital has to be maintained. Okay, the capital held shall not be less than the amount required to be held at the time of issuance of the PC enhanced bond. So when the PC was issued, or when the bank had issued the PC or the NBFC had issued the PC, at that time level, whatever capital requirement was maintained, that has to be maintained. That has to be maintained till the bond size is bigger than the PC. But as soon as bond size reduces and bond size is less than the PC, then the capital requirement can go below the initial capital requirement when the bond was when the PC was issued for the bond. Okay, in situations where the pre-enhanced rating of the bond slips below investment grade, so basically if the bond rating is going below the BBB minus, then the full capital has to be maintained to the extent of PC. So if PC is provided of 100 crores, 100 crores of capital the bank will have to maintain. Okay, because the junk rating has been given if the investment rating goes below, or if the bond rating goes below BBB minus. This is the idea. Now the PC facility that is drawn, that is taken by the bank, that is taken by the bond issuer. So PC facility that is drawn, that the money that has been taken out shall be required to be repaid within 30 days from the date of its drawal. So the money that has been taken, so basically the money that has been taken, so if 50 lakhs have been taken by the bond issuer, so within 30 days, the money has to be returned to the bank or the NBFC. This is the idea. The facility shall be treated as NPA. So whole facility of the PC will be treated as non-performing asset if the money is not returned by the bond issuer within 90 days. Okay. So this is the idea. Now the aggregate PC exposure of a regulated entity shall not exceed 20% of its tier 1 capital. So the total PC exposure that the bank has given, NBFC has given, that should not exceed 20% of the tier 1 capital of the bank or the NBFC. Next is additional conditions. So basically the tenure of the bond that is issued by NBFCs or housing finance companies for which PC is provided shall not be less than 3 years. That means the tenure of the bond should be at least 3 years for the bond that is released by the NBFCs and HFCs. So the PC that the bank or NBFCs are providing for the bond that is issued by the NBFCs or HFCs, for that at least the tenure should be 3 years. Okay, the proceeds from the bonds backed by PC from regulated entities shall only be utilized. So if the bond is issued by the NBFCs or the HFCs or the housing finance companies. So the proceeds that is taken from the bond should only be utilized to refinance the existing debt of the NBFC and housing finance companies. So refinancing the existing debt means replacing the old loan with the new loan, usually with better terms like lower interest rate, longer repayment period, or different structure. So basically, if the NBFC and the housing finance companies have taken the loan from a bank, let's say, has taken a loan from the bank previously, so this loan is being repaid. Now the loan is standard loan. Okay, the NBFCs and the housing finance companies is giving the payments on the regular basis. The loan that is taken from the bank is worth 500 crores, let's say, and let's say 300 crores have been repaid, only 200 crores is left, and the regular payments is being made by the NBFCs or housing finance companies. So this is a standard loan. In case of standard loan, let's say the NBFCs or housing finance companies have released the bond now for 200 crores, and for this bond has been released, and on this bond the PC is taken, the partial credit enhancement is taken to increase the bond rating so that more investors invest in this bond. Okay, now this bond proceeds or whatever money has been received from the bond by the NBFCs or HFCs, this can only be utilized to repay the earlier loan or to refinance the existing debt so that the earlier loans are paid. If they are standard loans, so they are repaid, and the new bond must have better conditions. Okay, this is the idea. So regulatory entities shall introduce appropriate mechanism to monitor and ensure that the end use condition is met, and only the bond money or the money that has been received through the bond can be utilized only for refinancing the existing debt. Now, the exposure of a regulated entity by way of PCs to bonds issued by each NBFC or housing finance company shall be restricted to 1% of the capital funds of the regulated entity. So this is the limit, that 1% of the capital funds of the regulated entity. This is the limit for the exposure of the regulated entity through the PC to bond issued by each such as NBFC or HFC. Okay. Now next is other aspect of PC. So effect of PC on the bond rating shall be disclosed. That means before the what was the bond rating before the PC, as well as after the PC what is the bond rating, because after the PC there is the security that is provided through the PC. So after the PC there is enhanced rating, there is higher rating. So it has to be disclosed that what was the rating before and what is the rating after. As well as regulated entity shall ensure that the project assets, let's say the bond is issued for a particular project, to build a residential property or to build a commercial property. So basically, if the bond is issued for a project, then whatever cash flows is happening from the project, let's say that the residential property, this residential property is like rented out and many people have started living in this residential property, or the some of the houses have already been sold. So whatever is the cash flows that have been gained from this project should be kept in the escrow account, should be kept in the third party account that is maintained by the bond trustee arrangement, that is maintained by the bond trustee, so that this cash flows can be used to repay the bonds or to pay for the loans and such that is taken for this project. So basically, if there is a project for which the money is taken through the bonds and such, so whatever cash flows is coming for this project should be used for repaying the loan first of all. So this is the idea, that cash flows from the project are ring-fenced, are taken in the escrow account, are taken in the third party account that is maintained by the bond trustee, so that this money is used to repay for the loans that the project owners have taken, or the bond that the project owners have issued to repay that. Okay. Now, regulated entities shall comply with all the related regulatory norms, and all the previous rules and regulations will not be followed after April 1, 2026. This is the idea. Now, the general conditions, the last part is the general condition. Just these conditions we have to discuss. So, the credit policy of a regulated entity shall incorporate suitable provisions for issue of NFB facilities. So, basically, this is general conditions for all the regulated entities, whatever guarantees or PC or co-acceptance bills that they are like issuing, whatever facilities that they are providing, whatever facilities the regulated entity are providing, they have to have the credit policy in such a manner that is having the suitable provisions for issue of the NFB facilities. Okay, so here limits have to be noted down, the credit appraisal, security requirement, fraud prevention, overall monitoring mechanism. So the credit policy of the regulated entity shall have enough provisions for issue of NFB facilities. Okay, next is the regulated entity shall issue of NFB facility only on behalf of customer having funded credit facility from the regulated entity. Basically it is saying that only those banks, only the bank that has provided the loan to a entity can provide the guarantee to the entity, also can provide the guarantee for the entity. So basically it is saying that the NFB facility can be provided by a regulated entity only on behalf of a customer having funded credit facility, having providing the funded credit facility from the regulated entity. So basically, let's say a contractor has taken a loan to build a road for the national highway. Okay, now this bank that has given the loan to the contractor can provide the guarantee on behalf of the contractor to the National Highway Authority of India. So the bank that has provided the loans or the funded facility to the contractor can provide the guarantee on behalf of the contractor. There is certain exceptions or exclusions in this case, because here provided that this clause shall not be applicable for the NFB facilities which are fully secured by eligible financial collateral. That means if the NFB facility, that is the guarantee or the co-acceptance of the bills or the PC, if it is fully secured by the eligible financial collateral, then any regulated entity can provide the guarantee or co-acceptance. So basically only the regulated entity that has funded the credit facility to a person can provide the non-fund based facilities for that person, because the regulated entity has already done the due diligence while providing the loans. So basically this bank, the bank XYZ, while providing the loan to the contractor for purchasing the tractors, for purchasing the required equipments for the contract. So basically the bank, while has provided the loan to the contractor, so has done the due diligence for the contractor, has already seen the documents of the contractor, the credit rating of the contractor. Okay, now this bank can provide the guarantee on behalf of the contractor to the National Highway Authority of India, or can for this contractor the bank can co-accept the bills. Okay, now it is said that if the contractor, let's say, wants to take the co-acceptance of bills or wants to take the guarantee from some other regulated entity, then the collateral will then the contractor will have to provide the whole collateral, will have to provide 100% of the collateral. So NFB facilities which are fully secured by the eligible collateral can be used, and then the regulated entity can provide the guarantee or the co-acceptance of bills to any other like obliger and such. Okay, now NFB facilities issued based on the counter guarantee of the another regulated entity as permitted. So NFB facilities can have the counter guarantee. So regulated entity that is providing the NFB facility can have the guarantee from another regulated entity also, okay, as permitted in the directions. NFB facilities on behalf of an obliger who has not availed any fund-based facility from any regulated entity in India. So basically, if the person has not taken any, if the entity XYZ has not taken any fund-based facility in India, has not taken any loans in India, has not taken any advances in India, so this XYZ entity can take the guarantee or co-acceptance of bills or any other PCE and such non-fund based facilities can be taken by this entity from any regulated entity. Now, NFB facilities extended by a regulated entity against no objection certificate issued by the regulated entity which has provided the fund-based facility. So, let's say State Bank of India has provided the loans to XYZ entity. Now, the Punjab National Bank is saying that we want to provide the guarantee to this XYZ person or for the contracts and such, or we want to provide the co-acceptance of bills for this XYZ person to get the fees. So the PNB will have to take a no objection certificate from the State Bank of India that can we provide the guarantee to this person, can we provide the co-acceptance of bills, or can we provide the partial credit enhancement. Okay, so that now derivative contracts entered into by regulated entity with counterparty. So for this there is no requirement for fund based credit facility. So basically a regulated entity that has provided the fund based credit facility should be providing the non-fund based credit facility to the obliger. Okay, but it has been said that if these rules and regulations are being followed, if any of these rules are being followed, then there is no requirement for the above condition to be followed. Okay, if the obliger is providing the collateral, if let's say the partial credit enhancement is being followed, in which the directions, all the applicable directions are being followed, that is the applicability criteria and such, as well as NAB facilities that have counter guarantee. In this case also, this direction or clause do not have to be followed. For NAB facilities on behalf of an obliger, where the obliger has not taken any loan in India, or there is no objection certificate that is taken from the regulatory entity that has provided the funded credit facility or the derivative contracts. In this condition, in these cases, the above clause will not follow. Okay. Now the last 2 points are, first of all, a regulated entity shall not issue a NFB facility to any entity assuring redemption or repayment of funds raised by any entity via deposits. So basically, a regulated entity shall not provide any non-fund based facility in case of the deposits of the people are involved. Okay, as well as in case of the bonds, if it is involved, then the guarantee cannot be provided, the PC can be provided, the partial credit enhancement can be provided. So in case the bonds are involved, the co-acceptance of bills are not applicable, the guarantees are also not applicable in the case of bonds. Only the PC can be provided. Okay, so a regulated entity shall not issue a non-fund based facility to any entity assuming repayment of funds or taking the guarantee for the deposits. Okay, issuance of bonds or in any other form unless specifically permitted by the regulated entity or by the Reserve Bank of India, by the Reserve Bank of India. So Reserve Bank of India has permitted the PC for the bonds, not the guarantees and such. So banks and NBFCs, they cannot act as a guarantor for repayment of deposits, debentures, bonds, etc. So banks and NBFCs, they cannot provide the non-fund based facilities for the deposits, for the debentures, for the bonds, etc. Only the PC can be provided for the bonds. That's it. Okay, this is the main idea. Once a NFB facility devolves, that means the NFB facility has finished and is converted into a fund-based facility. Let's say the bond issuer has taken the whole amount of the PC as the loan. In this case, when the bond issuer has taken the loan under the PC, so this loan should follow all the prudent guidelines for the credit. Okay, that means capital adequacy has to be maintained, provisions has to be maintained, the asset classification should happen that this is a standard loan or not and such. So this is the basic idea. Any confusion? So once an NFB facility has devolved and is converted into fund-based facility, then the prudential norms shall be as applicable to the fund-based facility as applicable to the normal loans. This is the idea. Okay, so these are the last 2 general conditions. First of all, NFB facility cannot be provided for the deposits, issuance of bonds or in any other form unless specifically permitted by the Reserve Bank of India. So the banks or NBFCs, they cannot act as guarantor or they cannot provide the NFB facilities for the repayment of deposits, for the debentures, bonds, but the PC can be provided for the bonds. This is the specific exemption that the RBI has provided, that the PC can be provided for the bonds, and there are certain bonds only for which PC can be provided, that has been laid down, that is the bonds. So the condition has been provided for that also, which bonds. Okay. Now the next one is that the fund based, if the NFB facility has converted into the fund based, that means in a loan or advances, so the fund based facility will follow the normal guidelines. So if the NFB facility, that is a guarantee or the PC, let's say has converted into a fund based facility, so it should follow all the prudent guidelines of a fund based facility. Any confusion, anyone? So this was a complicated guideline. I can understand there were so many of the clauses, so many of the exclusions also, exceptions also. So this can be a little confusing. So do see the session again to get the better clarity, okay, and just focus on the data points that is provided. So this is the first question. I hope you will be easily able to answer this question. Okay, so do try to answer this question. So here Which of the following statements is not true as per the RBI non-fund based credit facilities directions 2025? Now the second question is in regards to the regulated entity shall put in place suitable internal aggregate or individual ceilings for issuance of guarantees in general and unsecured guarantees in particular. For that there is some clauses that is given for the urban cooperative banks, for RRBs, for local area banks and such. So what are those clauses that has to be met? And if any regulated entity in breach of the above stipulation, that means if these limits are not being followed, it has to be followed by April 1, 2027. Okay, so this is the idea. Now another important thing that you have to remember is about the bonds. Okay, so remember that the PC facility, it is allowed for the bonds. The PC facility, it is allowed for the bonds, but only for those kind of bonds that is issued by corporates or special purpose vehicle for the different projects, and bonds that is issued by non-deposit taking NBFCs with the asset size of 1000 crores and above registered with the RBI. And if the NBFCs or housing finance companies are issuing the bonds, then these bonds should have, like, the proceeds from the bonds should be only utilized for the refinancing of the existing debt. And NBFCs and housing finance companies should have, if they are taking the PC, the tenure of the bond should not be less than 3 years. So these are some of the important points that you have to remember. Okay, so do see the PPT again, do download the PPT. The PPT will be provided in the Telegram channel of EduTap. So do download the PPT, read the PPT, read the important points, see the session. And if there is still any confusion, do write in the comment section below. It is a very complicated guideline. I tried to simplify it, but I know that it is still very complicated. So do try to see the guidelines or do see the session again to understand it. Okay, any confusion, anyone? Okay, then do see the session once again, or if there is any confusion, do comment down below what your confusion is. I will try to answer that. Okay, and I will bring some in the monthly revision session, we will discuss it again so that you have better clarity about the important points that you have to remember. Okay, mostly the whole notification is data points and important clauses and criteria. So full whole notification is important. So do see it. Okay. Okay then, thank you everyone. I will see Guru Raja. If it is relevant, I will take a session on it. Okay.